Good morning, it's Jeff Christian from CPM Group. It's Friday, the 14th of May, about 10:30 here in New York. Gold's trading around 1835 and silver's around 2740 or so. We had frankly thought that the prices would be a little bit stronger. I think a lot of other people did too this week, but the rise in interest rates kind of precluded that. I wanted to talk today about gold's relationship with inflation, interest rates, and the dollar and commodities I've thrown in there. But the relationship with inflation and interest rates has become a topic this week, partly because of the higher inflation figures, lower gold prices, and people were confounded by the idea of higher inflation, higher commodity prices, and lower gold prices. And I think that going through a few charts will help perhaps clarify that in the minds of our viewers. I also wanted to mention, there's been this explosion of video interviews and such with CPM Group. We did do our Silver Yearbook release on Tuesday the 11th. There's an hour-and-a-half presentation on YouTube, which is extremely interesting and detailed discussion, not only about silver, the real silver market of supply, demand, prices, inventories, investment demand, but also discussion about why the world's not running out of silver, mineable reserves and reserve base, silver above ground inventories. And in the yearbook, in discussing the inventory data, there is a brief history of silver market research, which clearly a lot of people don't really know about because, quite frankly, it's never really been much of a subject. But it discusses who's been doing silver research since the turn of the last century and the origins of CPM Group. Kitco did an interview with us yesterday. They talked about the LBMA mistake on its silver inventories, and we made the point there very succinctly. It's like, yeah, this is getting a lot of press from the DWs, the silver conspiracy people. But if you look at the core silver market, no one's really paying that much attention to it because the mistake, as egregious as it was, and it seemed to be a clerical error, and the fact that London inventories are 116 million ounces less than somebody mistakenly said they were at the end of March is actually not important to the real silver market, what really drives silver prices higher and lower. So we talked about that. We also talked about why gold didn't move on the inflation data. I'll get back to that in a second. We talked about international political risks. He called them geopolitical risks, but since geopolitics is a word that was coined by the British to justify colonialism and then used by the Nazis to justify Nazism, we tend to talk about international political affairs as international political affairs rather than geopolitical things. Although if you look at what's going on in India, the United States, and parts of Europe, geopolitics are coming back into play. And then he asked us about China's recidivism toward Taiwan, and it got into a little bit of the military issues and how China probably will pursue non-military pressures on the world about trying to capture Taiwan as a country. We didn't really talk about the fact that I don't know that that's going to happen, at least in my lifetime. We also did an interview back in January with a fellow named Ben Lakoff, who has a podcast called the Alt Asset Allocation. And it was posted, I think, this week. 63-minute interview. It's pretty long, but it starts off with him asking about my background, how I got into commodities research, as well as the history of CPM Group. And then we go into a variety of issues related to gold and commodities and precious metals, and it's very enlightening. So we're mentioning it. There's another person, Elliot Molling, who has a podcast called The Early Investor, and he has interviewed us, I guess, yesterday or the day before, and that is supposed to be posted on today, Friday the 14th, but we don't have a link. And then, of course, there's this one here today. So let's get to it. This is the relationship between gold and inflation. Historically, since gold prices were freed in 1968, The statistical correlation between changes in inflation and changes in real gold prices is 9%. Since 2008, when the global financial market and economy really sort of shifted gears in very important ways that are often overlooked, the relationship has been negative 5%. In other words, gold as an inflation hedge is not particularly good for the day-to-day type of inflation. Now look at that negative 5%. Inflation was actually flat to lower from 2008 to 2020, and gold prices rose sharply. So that's what you're seeing. So gold is not particularly a tick-for-tick inflation hedge, as the golden constant talks about, and we talk about this in the Kitco interview. I even hold the book up and read a quote from it. In the golden constant, Roy Jastrom talks about how gold is good as protection against cataclysmic inflation and cataclysmic events. But on a day-to-day basis, the correlation between the gnawing inflation that eats at earning power and buying power and gold prices is not all that great. And if you take the broad view and you'd say, well, you know, gold prices today at $1,835 an ounce, what is it, the real purchasing power that would have been in effect in 1776 when Adam Smith wrote The Wealth of Nations, the price would have been about $5,000 in today's dollar terms. And Adam Smith in The Wealth of Nations in 1776 said, by the way, the buying power of gold is going to deteriorate going forward for a variety of reasons, which I won't bore you with. So when inflation numbers popped up this week, gold prices actually didn't rise. They fell. And they fell partly because of the inflation numbers and what was pre-done, and partly because of interest rates. And I'll get to interest rates in a second, but let's talk about inflation. Jerome Powell, Janet Yellen, mainstream economists who actually studied economics and understand financial markets have said, and were saying quite vociferously last week, look, there's going to be an uptick in general price inflation as we come out of the recession, come out of the lockdown, and the pandemic starts moving toward the past. In addition to that, when you're measuring year-over-year inflation in April 2021, you're measuring it against April 2020, which was the beginning of the lockdown when everything fell in value as we tried to figure out how we were going to live locked down. So you're looking at a year-over-year figures that are hyperbolated, and you're looking at figures that are coming out of that lockdown with a lot of people having a lot of pent-up money, starting to rebuild the things that they haven't been purchasing, starting to go places. It's very interesting, and there is inflation there. Now, these guys, the mainstream economists, said inflation is going to pick up on a transitory basis, and we're not necessarily worried about inflation. And the reason they said that is because of this chart here. Inflation hasn't really been a big problem since 1982, 1983. And in fact, the Fed keeps talking about how inflation is too low on a core inflation ongoing basis. There are a couple adages in Wall Street. One is one data point doesn't make a trend. So they were saying last week, expect an uptick in inflation figures because of these changes in the economy coming out of the lockdown. And we expect it to be transitory. So we're not that worried about it, and we're probably not going to do much about it until we see where it goes. And if you disaggregate the PPI that came out yesterday and the CPI that came out Wednesday, you can see it's very interesting. The core inflation figures were actually higher than the headline figures, which is unusual. Headline includes food and energy costs, which tend to be more volatile than most other costs in the economy. So the headlines tend to be more volatile because they include that. And a lot of people look at the core non-food, ex-food and energy figures. And the ex-food and energy figures were stronger because people are coming out of that lockdown and they're buying stuff, and the supply chains are interrupted. And that's an important thing to know because that has a lot to do with the transitory nature of the inflation figures that you're seeing. If you were saying, okay, we're not growing stuff, we're not mining stuff, we're not manufacturing things, then you have more inflationary pressures that are more problematic. But if you're saying, no, the factories are working, the farms and the mines are working, and people are buying this stuff, but you just can't get stuff from mine to market, that's something that's much more easily fixed. And so that adds to the view that these things are transitory. So that's one of the reasons why when inflation figures came up Wednesday, Thursday, and they were high, you didn't see the gold price shoot higher. There's another adage in Wall Street, which is buy on the rumor, sell on the news. And you saw gold prices rise $55 last week. They fell $25 this week, but the reality is that they're still $25, $30 higher than they were 2 weeks ago. So as people were listening to Yellen and Powell say, oh, there's going to be an uptick in inflation figures coming out, they were buying because they figured, okay, people will see higher inflation figures and run into gold. And they bought on the new rumor. And when the news came out and the inflation figures were higher, they actually got out. And they got out at a higher price than they had bought in. So that was one of the factors. The other factor is that interest rates ticked up. I mean, the 10-year T-bond got up to 1.69% 2 days ago. It's back down to about 1.66 the last I looked. So you saw rising interest rates. And those rising interest rates are important because when you see higher inflation, sometimes it affects gold and sometimes it doesn't affect gold. Sometimes when you see higher inflation and higher interest rates, you'll see people say, okay, inflation is becoming a problem. I don't think the Fed can handle it, so I'm going to buy gold because I think inflation is going to be a problem. Other times, investors will look at the exact same data and say, okay, inflation is rising, interest rates are rising. I think the Fed can control this the way they have consistently since 1983. Let's go back here. Every time you start seeing inflation, they've controlled it. So inflation has been kept under control. And sometimes when you see higher inflation figures and higher interest rates, people say, okay, the Fed is doing its job. It is, as William McChesney Martin said, leaning into the breeze of inflation. We're seeing signs of inflation. Interest rates are rising to sort of help cool off demand so that inflation doesn't become problematic. So gold prices were weaker this week for a variety of reasons. One was that people were taking profits from the purchases they had made $50 lower a week ago. And another one is that the interest rates were rising. I threw in two other charts, gold versus the dollar. Not a very good correlation. I'll get back to that in a second, but people are talking about it. And as they move away from inflation and interest rate discussions this week, they'll probably be talking about how the dollar is going to collapse any moment it's going to collapse. You can see here that, it got down to 80 on a trade weighted basis. And now then it got up to 105 and now it's down to 100, which really looks like a terminal decline in the gold price or the dollar to some people. Doesn't look like it's particularly collapsing to me, but that's my opinion. And then gold versus commodities, because another meme you heard was that why is it that gold prices and silver prices are falling this week while other commodity prices are rising? And anybody who has listened to us or read our research, and I realize that a lot of people who comment about our work have never listened to us nor read our research, know that we say, look, gold and silver have three functions. They're commodities. They used to be monetary metals used in the monetary system, and they were financial assets. And we always say that gold and silver are not the same as commodities. They are primarily financial assets. Gold and silver, if you look at the way they trade around the world, trade like currencies and interest-bearing securities. They trade like T-bonds. They trade like dollars. They do not trade like soybeans and pork bellies, right? So you've got a situation where CRB prices have actually been rising, but look at them. They've been, the CRB, Commodity Research Bureau's index of commodities, yes, they are rising, right? And this only goes through December. They've gotten higher, but look where they were for a decade before this. They've got a long way to go before they're problematic. But commodity prices have been rising because we're coming out of a lockdown, and gold prices have already risen. And gold is a financial asset, not a commodity. Here's the actual correlations, and we take the long-term view and the short-term view. And short-term, we mean 12 years. From 1970 to 2000, the correlation between inflation and gold was 9%. As I said, month-to-month changes. 2008 to 2009, negative 5%. It's not that gold is no longer an inflation hedge. It's that inflation hasn't really been a problem, at least in the United States, since 1982. If you go to places like Turkey in the 90s or Argentina in the aughties, and where you had significant inflationary problems, people were buying gold and gold prices were rising in those economies. Trade weighted dollar, negative 33% correlation in the long run. And over the last 12 years, it's gotten up to negative 37%, which means that if you're trading gold as a dollar contrarian, you'll be wrong 63% of the time. Congratulations on that trade. Dow Jones, -4, -4 for the S&P, 0 for T-bills and T-bonds. That is one of the things that makes gold so good as a safe haven and a portfolio diversifier. It's not that they trade opposite stocks and bonds. It's that they don't trade opposite or positively. They're neither positively correlated in the long run, nor negatively correlated with stocks and bonds. And that's what you want as a portfolio diversifier. You want something that smooths out the value of your wealth over time by being uncorrelated with other assets you have in your portfolio. And then silver we threw in 78%. Now, all of this data, all of these charts exist in two places. The charts and data that I used here today, I derived some of them from our gold yearbook, which came out in March. It's $160. You can order it from our website. It's an ebook. You get it immediately. And a couple of the charts came from our precious metals advisory, which you can also order a single copy or an annual subscription on our website. You can go to our website and buy the silver yearbook, which was released this year. So you've got, as I said at the outset, about three or four hours of videos about CPM Group talking about the world, the economy, the political environment, gold and silver that you can listen to over the weekend. And you can download a 222-page silver yearbook and a 220-page gold yearbook, and you can read those things over the weekend too. So you could spend your weekend delving into the precious metals research and views of CPM Group. Or you can go out and enjoy some spring weather if you're in the northern hemisphere, some nice autumnal weather if you're in the southern hemisphere. That's about all we have for now. We'll speak to you next week. We'll be doing some other things. We're also going to be doing more of these interviews with various other people. And then we do have the open forum on silver that we're shooting for May 25th. Thank you and goodbye.